Starting for Chapter 5 here after our first exam in Accounting 101, we are going to transition away from a service-type business and into looking at selling actual goods, selling what we consider inventory in a business. When you sell inventory in a business, the first new thing that you definitely have to know for this class is there are going to be 2 journal entries. Every time you make a sale, 2 journal entries. The first one we're already familiar with. It's what you do when there's the same as you would do with the service revenue. You're going to show that you either got the money, the cash, or that your customer is going to pay you in the near future with an account receivable, and then you're going to credit the sales revenue. In this case, sales revenue instead of service revenue. And then there may be some additional credits below that, but that's the first main entry. The second entry, the new entry that we haven't done yet, that will involve some new accounts, is called removing the inventory off of our books. Because when we buy the inventory initially, we put that on our books as an asset. For example, look at my first example here. If I purchase 150 units to resell in my business, and I buy them for $2 a piece, my initial entry is to inventory, and that's an asset account. So I'm going to debit my asset account for $300 and credit the account payable that I owe the store $300. I did not put this amount here as an expense. There is no such thing as an inventory expense. Inventory is similar to a prepaid account. So it's something that I still have or I still own, and I will get the benefit of it, meaning I will sell it and get money in hopefully the near future. So right now it's considered an asset because I own it. But when I turn around and sell it, then I'm going to remove the inventory, and I'm going to create a brand new account to us called Cost of Goods Sold. And we're going to usually abbreviate it just as COGS, C-O-G-S. And that falls as an expense account. So that's the first new terminology that we're going to look at for this week, is our terminology for COGS, Cost of Goods Sold. It's an expense account, and it's something that we debit like any other expense in that second journal entry when we have a sale. So let's look at a sale little transaction here. So of the 150 that I bought, let's say within that first week or so, I sold 100 of those units. And I sold them all for cash, and I sold them for $3 each. So I had a decent markup here. Well, so how we would journalize this, the first part of the journal would go exactly the same as we're used to. I would ask the question, what did I get? And I got cash for $300. Why did I get the cash? Because I made a sale. So that would be my first, and that's our normal journal entry. Just got misplaced. And then the second journal entry would show, well, I made a sale, so I no longer have some of those inventory items. I need to get that inventory that I put on my books, the $2 a piece items, back off of my books. So when I take them away, I need to expense them because they're now gone, and I paid money for it up front. So I call that cost of goods sold, the cost of the goods that I actually sold. They cost me $2 a piece, and if I sold 100 of them, that's how I get the $200. And I'm going to take it out of my initial inventory amount. So I'm really only left with 50 items in my inventory that cost $2 a piece. So $100 would be my ending inventory T account balance. And that's simply what I have explained here. Expenses are going up because we have now removed that inventory. We got the benefit of our inventory, just like a typical expense. The benefit was me being able to raise money, do the business that I do. But then when you look at this actual transaction, I brought in 300, yes, but out of that 300, it cost me 200 just to get the stuff. So really, I only made a net of $100 instead of back when we had a service, the full amount of the revenue was our actual gross profit. But in this case, we have to take it down a little bit because of that initial upfront expense with the inventory. Let's transition now and begin, and we're going to look at some more items here in just a few minutes. Actually, before we do that, the next thing I wanted to look at on our list of new stuff, our new account is called sales tax payable. Sales tax payable, that's a liability. And sales tax only goes to the end user. So what I mean by that is, let's say if I'm Target, and that's my business, I'm the retailer. Well, Target usually buys their goods from somebody else. Maybe they bought footballs from Wilson Company. When they buy these footballs, Target does not have to pay a sales tax on that. The only people that pay sales tax are people like you and me who go to Target and actually buy the football. So sales tax is only on the end user. And also the sales tax payable is only a seller account. It's only a liability that the seller collects. It's not the seller's money. They just collect it, and then they pass it on to the government. The buyer, on the other hand, they include this cost in the initial price of their asset. So if I'm buying that football and it cost me $15, and let's just say for ease purposes that it was $1 tax, that football on my books would cost me $16 because I'm going to include the tax right into the cost of the asset. And that's what I wanted to show you here. Well, okay, if sales tax gets included, what else gets included in the cost of an asset that I purchase for my business? So no matter if you're purchasing inventory or equipment, so inventory are things that we plan on reselling, equipment are things that I plan on using in the business. The general rule is any costs that get the item ready to use or sell are included in the asset price. So some of those costs would include 1 through 4 here. Of course, the sale price, the actual sticker price of the item. But then we have sales tax. That's a cost I have to pay to get it to my store. Shipping, if there is shipping involved and I have to pay it as the customer, then that cost gets included in the price of the asset up front. If there's any installation to get the item ready to use, like for equipment, more likely, that's going to go into the cost of my equipment. There is no separate installation expense. And then I would deduct the price of my asset if I did return something. Hopefully that makes sense. And then we're going to talk about discounts and how we maybe get a discount. And if we do get a discount, that's going to also take away from the cost of my asset because it didn't really cost me that, but I got a discount for it. Okay, let's look at transaction 1 and 2. I'm going to pull up that here in just a second. So when we look at the first example that you should have on Ring Bling, number 20, I tell us we start out with a balance of $50,000 in cash and capital. That's just so we have some upfront money to work with. But our first entry on July 5th is we're buying as a ring store or a jewelry store. We're buying 4 different pieces of jewelry. So these are all going to be ready to resell. And so what I want to do is simply record this journal entry, but also keeping each one of these separate off to the side so like a little sheet that tells me how much each of them cost individually. So when I go to do my first transaction, I'm simply going to have on July 5th, so let's put the date here, 7/5, I bought inventory. I can go ahead and lump it all together for my T accounts. I bought inventory, and I owe I owe my supplier the $1,300. When you add up all of the 4 pieces of inventory that I bought, it was worth $1,400 or $1,300. Now, the second entry that happens is we're going to make our first sale. And before we even buy any of the display cases, we go ahead and sell a ring. Now we are going to sell rings, but they are going to be to an end user, so there will be a sales tax. To make it easy, I've just made it a 5% sales tax. Here in Indiana, as you probably are aware, it's 7%. And then if you eat out, it's an additional 1% on top of that. It's an 8% tax if you eat out somewhere. And the last thing to note is I've given us all of the purchase price that we bought at Ring Bling. But now we're going to show, we need to determine how much is Ring Bling going to sell it for. And the store policy is we mark everything up 500%. So that takes us to one of the last things that I wanted to cover. Well, not one of the last, but one of the last things over here is how to do a markup. So if your sale price is unknown, as it is in this case, how we want to figure out the sale price is we take our original cost, so whatever it is that we're selling, and then we're going to multiply that by 1 as a decimal, just 1, plus the markup. And we want to put the markup into a decimal as well. So in this case, 500%, whenever you have a percent and you want to take it to a decimal, you always just move the decimal 2 places. So 500% becomes 5. Whereas if it was a 25% markup, 25% move it 2 places becomes 0.25. But with our case, as again, it's 500%, so 1 plus 5 is 6. So I want to take 6 times the original cost. And remember, we are selling the diamond-shaped ring. The diamond-shaped ring we bought for $400. We'll multiply that original cost by 6, and that would be our sale price. So 6 times 4 is $2,400. That's what I'm getting here. A lot of times off to the side, what I'll want to do is add up all the items that the customer owes me. So off to the side here, I'll have like a little number 1, and it'll be sale price, and a little number 2. A little number 2 off to the side, and it'll say, well, let's just do that here. So I want to list my sale price, $500, and I'm also going to be getting from my person sales tax. Oops, not 500, that's 500%. So the sale price is actually $2,400. The sales tax is 5% of my sale price, so 5% of $2,400 is $120. So the total that I'm going to be charging my customer based on this information is $2,520. That answers my debit question. What did I get? I got my customer is going to be owing me money at $2,520. And then the credit is simply the 2 items that I just listed in my problem. Where does the $2,520 come from? Most of it is my money that I'm going to be earning and keeping, the $2,400. The remaining that's left over is the sales tax payable that's going to go on to the government of $120. Now, I'm not quite done yet because whenever I sell something, I always have at least 2 journal entries. And the second journal entry is going to show that this diamond ring is now gone. I don't have it in my inventory anymore, so I need to get rid of it. And how I get rid of it is by setting up a new T account called COGS, or cost of goods sold. So debiting that expense, COGS, and showing that the inventory is now reduced by that $400. So if we were looking at the T accounts for this problem, anything in green is my first transaction. So let's look at those 2 first. We got the accounts payable there for $1,300. And then I scroll down to my inventory, and there's my debit for $1,300. And then with the second transaction, I had a debit for $2,520 that my customer owes me. And remember, the customer owes me because I made a sale of $2,400, and I also, of the $2,520, included some sales tax. The final entry showed the inventory leaving the store, so that's where that $400 comes from. $400, that necklace is now gone, and I would have debited it to my cost of goods sold account as an expense for $400. Now, what we're going to do here, starting with number 3, and for the next few going down, we're going to do the journal entries from both perspectives, because it's important to be able to practice from what's it look like when the buyer buys something, and how does it look if the seller sells it, or when the seller sells that same item. How do the two entries differ? I'm going to be keeping the T accounts for Ring Bling, and I suggest you do the same. Manufacturer, I'm not going to keep their T accounts. We're just going to show what the journal entry would have looked like. So now off to the side, what I want to do here is list what all costs go into my assets. So number 1, we have the sales price. Number 2, we have if there's any sales tax. And those are the 2 things we have so far. So Ring Bling, the sale price, I bought 10 store units, and each one cost $2,000 a piece. So 10 times 2,000 is 20,000. Sales tax on 20,000 at 5% would be $1,000. So my equipment that I just purchased is valued at $21,000. And so that will be my initial journal entry. So I'm going to come up here, and for the first journal entry, I'm going to have a debit to my equipment for $21,000, and an account payable to my manufacturer for $21,000. So note, there was no sales tax expense because the sales tax was included right into the cost of the equipment. So that is my entry there for this Ring Bling purchase number 3. Now, from the manufacturer's point of view, I'll put the manufacturer over here on this side. The manufacturer, well, they have an account receivable to us, Ring Bling. And they're expecting to collect $21,000. What I need to do then, just like what I did above in my number 2 example, I need to break down this $21,000 and show where it comes from. Most of it for the manufacturer came as sales revenue, the $20,000. The rest of it is going to be labeled sales tax payable for $1,000. Now, I'm not done yet, because from the manufacturer's point of view, they're the seller, so they also have to do the second journal entry, which is cost of goods sold. Cost of goods sold, remember we credit then our inventory account. How much goods did I get rid of? Well, I got rid of that one piece of jewelry, and it cost me $400. So that's what I need to expense, $400 of inventory. The only thing that I want to put in my updated T accounts is that I bought a piece of equipment for $21,000 and add that into my new account payable for manufacturer for $21,000 that I owe them. The next thing we come to in the transaction is, well, we are returning a piece of the the display cases. We actually don't need 10, we only needed 8. And so they are willing to take back their display cases. So that leads us to our next new item for this week's stuff, which is a sales return. A sales return account is only for the seller. The seller only will record a sales return account. And it's a contra account. It's a contra revenue. A sales return, when you're the seller, will look just like a normal sale will. So it will have 2 journal entries. And the 2 journal entries would be just a reverse of what the regular sale entry looked like. So instead of having a debit to your account receivable and a credit to sales revenue, you're going to flip it. You're going to have a debit now to sales return and a credit to AR. You're taking money off of their bill. They don't owe you for that anymore. And then the second part of the journal, the second journal entry, instead of debiting cost of goods sold to show that you got rid of equipment, you're actually going to debit your inventory to show that you, or in this case, when you're the seller, you're going to debit, your inventory and credit your cost of goods sold because you didn't really sell it. You now have the items back in inventory. But when you're the buyer, all you're simply doing is reversing your original purchase. So my original purchase when I was the buyer said I bought equipment. I credited the account payable showing I owed money. So now when number 4 comes along and I'm giving back a piece of my the equipment, let's go back to my, let's actually write it out. What's going to happen here in number 4? So I'm going to return something with a sale price, and that sale price was $2,000 a piece. So a total of $4,000 of goods that I'm returning. But then I'm also returning, and I should be getting back some sales tax from that original 2 items that I no longer need. 5% of that sales tax would be $200. So now it's time to start journalizing this. So as Ring Bling, this is how much stuff that I'm getting rid of. So when I go to my transaction, I need to show I no longer owe $4,200 worth of debt because I've returned that product that was valued at $4,200, the cost and the sales tax. But then I also need to show that I no longer have that equipment on my books that was valued at $4,200. From the seller's point of view, I'll start it right here with number 4. We're going to do almost identical to this, with the only exception being the sales revenue. We're now going to call it a sales return. We had a return of $4,000 just in product. We had a return of the sales tax that I have to give back. And all of that is going to come off of my customer's bill, Ring Bling. And then part 2, I need to do a reversal of this. And I need to go back for a second. It is not really $400. Let's go back to my wording. I don't know why I put 400 there. I think that was because of the necklace. The manufacturer isn't selling necklaces. They're selling display cases. And if I go back up here, it tells me that the display cases cost the manufacturer $750 up front. That's what they that's what it costs for them to make it, $750. So when I come here, this should be 750 times 10 because I sold 10 of them. So therefore, my cost of goods sold is really $7,500. And then when something is returned back to me, I'm going to debit my inventory for that $750, but then there were 2 of them, so that would be $1,500. And I need to credit then my cost of goods sold to take $1,500 back off of the expense. Now again, I'm only doing the journal entries for this one for Ring Bling. So I'm only going to have the two accounts being affected on these two transactions. So there's my account payable for the manufacturer, showing that I owed 21, but I just took off 4,200 there in example 4. Then I come down to my equipment, and I showed that I bought $21,000 of equipment, but I simply subtracted out $4,200 of it because I gave it back. Okay, takes us down here to number 5. We're now ready to sell another item. The difference with this one, everything's the same. We've got sales tax, and we've got the only other thing here is Ring Bling offers a new item, and this is called a sales discount. Sales discount, when it says 315 net 60, these could be any numbers. They don't have to be these numbers. The 3, the first number, is a % off. That's the percent that the seller is willing to give me as a reduction in the price if I pay my full bill within the next number in days. If I pay my full bill off in 15 days, they're going to give me a 3% discount. Otherwise, the last piece is known as when your total bill is due regular. So total bill is due in 60 days with no discount. But again, if I pay within 15, I get a 3% discount. So when I look at this with this discount option, that's not something I really need to worry about on the first day when I buy it, because there is no discount yet. All I did was I purchased it, and this tells me that I purchased it on account. They wouldn't have given me this continued option here if I would have paid for it right now up front. That would be silly. But by showing this, that's telling me that I bought it on account, and that if I pay in 15 days, I will get a discount. So we'll come back, and I'll show some instructions on what that discount looks like here in a few minutes. But let's enter in here our things that we know. All right, first thing I know is the sale price. Well, I can easily figure it up. Let's figure it up. It was, I'm selling the princess cut ring. So we go all the way back up to the beginning. The princess cut ring is $250. Remember, Ring Bling marks everything up 500%. So I need to take 250 times 1 plus the markup, 500%, which is 5.00. So my sale price actually is 250 times 6. And just, if you can't do it, bring up your calculator, but 250 times 6 is $1,500. And then I'm going to be paying sales tax, and that's 5%, so that is $75. And now our new item, remember when I was looking at buying something as an asset, we had the sale price, the sales tax, and then further down we had a sales discount. Well, this would be a negative. If my customer gets this, I'm going to count it as a negative in the total price. But as of today's date, on the 7th, I don't know if my customer is going to get it. So right now I have to leave that in the question. So as of right now, I can do my journal entry. I can show that I'm going to bill my customer $1,575. So, okay, let's come over to our journal entries. And for number 5, I'm going to show an account receivable to my customer. I'll just put customer. I don't remember if I had a name or not. But and I remember that it was for $15.75. And now I just simply need to show where did that money come from. Most of it came from my sales revenue. And the remaining part came from my sales tax payable. That's all the information I know right now regarding my cost to the customer. But I also need to update my cost of goods sold because I did get rid of this particular ring. And I can remember back that it cost me $250 to buy it up front. So that's an expense that I need to show as a cost of goods sold. Now over here from my customer's point of view, the one thing that I wanted to note here is my customer is actually a retailer because I'm selling it to another retailer. The only thing is I needed to make an exception because I did want to show the sales tax being included. So we're going to pretend that neither of these parties know about that special tax rule that's only to the end user. And we're going to go ahead and charge them tax just because I do want to show an example with tax. But I also wanted this to be a retailer and then to know how they're going to put it on their books to show it as inventory. So when the retailer gets the item, they're going to debit their own inventory account, and they're going to debit the full price that they are charged, $15.75. And they're going to ask the question, how did I get the inventory? And they'll say they got it on account, and they owe me money, Ring Bling, $15.75. Now, the next section of this, number 6, shows that payment was actually made. So I come down here, and the other retailer paid us the entire bill. So they paid us on the 18th. I sold it on the 7th. So that's 11 days. According to my discount policy, they have 15 days to get the discount. So they got it. They get a 3% discount. Now, what I want to do, instead of doing this as my little off to the side typings that I need to update my books, I'm going to do the same thing, but I'm going to show how we get the discount and how to do the journal entry in 2 hopefully easy steps. Step 1 is we just want to find the discount, determine the discount. And how we're going to do that, don't just jump to a conclusion here because I want to read it real carefully. Ring Bling offers a discount of $3.15 on the base price only. So the base price was really $1,500. Yes, I charged them $15.75, but that included tax. I'm only offering a discount based on the base price. So to determine the discount, I'm going to take the $1,500, which was my base price, and times that by the 3%. And when I do the math, that comes out to be $60. No, $45. So they get a potential of $45 discount. Now step two, what that involves is there's going to be 3 entries that are going to happen when I do this as my journal entry. So 3 numbers. The first thing I want to do is find the bill. What was the bill before discount? What was the amount? And the amount was $15.75 that I billed them. And then I want to subtract out the discount amount that I just found. So I want to subtract out $45. And then total, what that's going to tell me is how much was actually paid, or if I'm getting money, how much was received. So $15.75 minus 15 or minus 45 does equal $15.30 in amount paid. Now we're ready to do the journal entry, knowing that these 3 items are all going to be in my journal entry. So, okay, we're ready for part 6. And the key is here, the other retailer paid me Ring Bling. So I asked myself, what did the company get? What did Ring Bling get when I was paid? And hopefully you can say that they got cash. We got cash of $15.30. So let's come down here to number 6, debit our cash account for $15.30. Now I want you to skip a line, and let's go ahead and do the credit next, and then we'll fill it in with the missing item. Why did I get the cash? Where did it come from? Well, it came from my customer's AR. The customer's AR shows, if I go back right here, they owe $15.75. And then I need to think, how much do they owe after they pay me in full with the discount? And hopefully you think, well, they don't owe me anything. So I'm going to credit my account receivable to the customer, $15.75. The difference then, is what we call for a seller a sales discount. It's a contra account, and it shows that I gave them a discount, which is a contra revenue, so it's going to take away from my revenues, of $45. Now, from the buyer's standpoint, we're going to ask the same questions. What did I get when I paid my bill? I got a reduction of my bill to Ring Bling. I no longer owe them anything. Complete reduction. Why did I get a reduction? Because I paid cash. However, as I showed in my steps, I only paid cash at $15.30. The difference when you are a buyer, over here the difference when you were a seller was a sales discount. When you are a buyer, you actually credit the stuff, the asset that you bought. Because that asset that I bought originally was on my books for $15.75. If I keep it at $15.75, that's too high. It didn't really cost me that. So I need to credit that same inventory account and take back off $45 to show that I actually did get a discount. That would be my journal entry for number 6. Now, to kind of summarize what we just did with discounts, that takes us to step 4A and 4B. So when you're the buyer, we look at it as a purchase discount, but there is no T account called purchase discount. All we do as the buyer is if we do get a discount, we reduce the cost of the asset that we purchased. And if we're the seller, we create a new T account called sales discount, which is a contra revenue account. And that is for the seller only. As we look now to the last couple items, the transactions, we're going to now look at shipping. The last new thing I want to look at is shipping. And so what I'm going to bring up our last new stuff that we need to look at. There are 2 different terms for shipping. One is FOB shipping point, and the other is FOB destination. FOB simply stands for free on board. And how I like to think about it is call it free to the customer all the way until the shipping point. So if I was to draw a little map, I've got the main warehouse, our delivery people, and then my store, the retailer. When it's FOB shipping point, think of it as it's free to me, the customer, all the way from the warehouse to the shipping point. The point to where it gets shipped is right here when it gets to UPS's dock. This amount right here was free to me as the customer. However, I actually pay the shipping expense to take it from UPS all the way to my house. Whatever that expense is, whatever UPS charges, that's on me. And if it's on me, the buyer, then remember what the buyer does? The buyer includes it in their cost. So the buyer puts it right into their cost of the asset. And the seller, even if the seller has to be the one that actually pays, kind of like sales tax, the seller actually pays the government sales tax, but they don't count that as an expense. It's a payable because the customer is the one that's actually giving them the money. So the seller will bill the customer just like how they're billing for the actual goods in the sales tax. And then they'll create a temporary liability to the UPS, just like they do with sales tax payable, to then send it off once they get it to the UPS. So the buyer was the one who actually pays for this shipping cost, and they're going to include it in their asset. So when we look at the transaction for number 7, everything's the same as what we just did, except the only thing now is there are shipping charges of $200, and the terms for my company, Ring Bling, are FOB shipping point. So remember, that means free on board until it gets to UPS. So therefore, the customer is the one that's actually going to be paying the bill, even though UPS charges me up front. The customer will need to reimburse me. So my journal entry, how it's going to look, from number 7, from Ring Bling's perspective. Again, I could go back here, and this is kind of what I want to do first, is I want to show the steps again. I want to show, okay, 1, the sale price that I'm going to be collecting was $1,500. Number 2, the tax that I'm going to be collecting was $75. Number 3, the shipping that I'm going to be collecting, because my customer owes me, because they're going to reimburse me, the $200. And then finally, the 4th item, and maybe 200. I thought I had changed that. Let's change that. That's a little extreme. Let's change that to $30. Let's change that to $30. Well, you can change. I'm just going to change it here. It makes it a little discount. We don't know yet. We don't know if they're going to get a discount based on July 7th date. So I'm ready to do my journal entry for Ring Bling, knowing that my customer owes me $1,605 when you add up all 3 of those items. So I have an account receivable to my customer for $1,605. And now I break down where that $1,605 comes from. Most of it comes from sales revenue. Some comes from sales tax. And then the rest, I'm going to also pay to UPS. The remaining $35 goes to UPS because it's actually their money. I'm just holding it temporarily. Part 2, the cost of goods sold, that didn't change at all. I still got rid of a $250 item that I need to show leaving my inventory. Now, from the other retailer's perspective, they're buying inventory, and that inventory on their books is going to be at $1,605, what they're actually going to be paying for it. And they need to show that they have an account payable to us, Ring Bling, for that $1,605. Now, I can go ahead and let's go ahead and do the part B of this one, so 7B, which would be when they actually make payment. So I want to come down here and I want to do my steps again. I'm going to copy and paste so I don't have to remake all this. So on the 18th, we need to determine the discount. Remember, the discount's on the base price. So when I add in shipping, that doesn't change my base price any. it's still $1,500 at 3%, which was $45. The only thing that does change is the bill before the discount now is $1,605 instead of $1,575 because of the shipping. So $1,605 less the discount will be my final bill of $1,560. That's how much actually needs to be paid, so I can do the transaction. So what did I get? Ring Bling. Ring Bling got cash. And we just figured up how much, $1,560. I'm going to skip a line because I can answer the credit question very easily. Where did the $1,560 come from? It came from my customer who now has nothing on his account receivable. It's all taken care of. And it's all taken care of because they did get the sales discount of $45. Now, from the customer standpoint, what they're going to say is, I got a reduction on my account payable to Ring Bling. I'm going to take off my entire amount due, $1,605. I'm taking it all off because I paid cash of $1,560, and they gave me a discount on the inventory, so the inventory didn't cost me that extra $45. Now, the only thing that's different with number 8 is the terms have changed to FOB destination. What that means is now it's free on board to the customer all the way until it gets to the customer's house. So therefore, the retailer has no clue what the shipping is. They don't need to know. So the journal entry at first is going to be identical to what it was in number 5. So I'm going to simply copy and paste it. So for number 8, to copy and paste. And that was the wrong one. I didn't do number 5. So with number 5, remember there was no shipping. The customer simply owed me the $1,575 with the sale and the tax. So this was number 8. The only new thing now, I'm trying to delete this. The only new thing is the customer doesn't owe me any shipping. That shipping is on me as the seller, and I call that a shipping expense for the $235 that it cost. And again, I'm going to be owing UPS. So the credit stayed the same. It was still a $35 credit either way to UPS that I owe them money. It's just with FOB destination, I'm going to debit the shipping expense to show that it's my money that's being paid out, and I'm not getting it back. Whereas with number, as with the shipping expense, it actually went to the customer. Yeah, added into their bill. Okay, I think this was long enough. I'm going to stop it at this point. You can work on number 9. We'll go through number 9 in class. If you haven't done so, so go ahead and do it. We're going to review the answers to number 9 and see how you do as a quick review before we do some actual lecture, some more examples that we're going to do in small groups. At that point, I will see you in class.